With just over 10 minutes left until the closing bell on Wall Street, we're looking at how to navigate the big picture with the Yahoo Finance playbook. Today, we're taking a closer look at how the Fed could impact your portfolio and what's driving the broader market rally.
Yes, we're highlighting expectations for the Fed's March meeting and what that means for your investment decisions now and looking ahead. Joining us now is FM Investments President and Chief Investment Officer Alex Morris and Macro Institute Chief Investment Strategist Brian Nick. Thank you both for joining us. And Brian, I want to start with you. Obviously, all eyes on the Federal Reserve and their interest rate decision tomorrow, but I do think the biggest focus is going to be on that dot plot. So what are your expectations for that?
So this might be a weird Fed meeting in that the markets and the Fed are relatively aligned coming into it, which has not usually been the case. The market's been looking for the Fed to make pivots here and there in the last couple of meetings. I think this one, the market and the Fed are both expecting kind of the same thing as the last time we've heard from them. And the Fed speak since the January meeting doesn't indicate we're going to be getting a much different message on inflation or on the unemployment outlook. So my base case is that we're going to continue to see expectations baked in the Fed dot plot for 3 rate cuts this year. That's about what the market's expecting too, which means potentially not that many fireworks after the announcement tomorrow.
All right, Alex, I want to bring you in here as well. What's your take, Alex? Tomorrow, what are you expecting the Fed to do and say tomorrow, Alex? Are you expecting the same thing, not a lot of fireworks?
Yeah, I'm hoping for no fireworks. I guess we're always kind of hoping for that. But I agree. I think we're going to see rates held steady. We're going to see the dot plot look pretty much the same. I wouldn't be surprised, though, if there were some outliers who pushed us to 2 cuts or someone who might even be looking at 1. Which I think might spook the market a little bit, but I think the odds of that are low, and any response would be relatively muted.
Alex, just a quick follow-up on there. Does it matter to you, Alex, when exactly they start cutting?
I think it matters less to me than it does to them, and that there be a regular program, and that's because what's about to happen in November. The Fed, although it is by design outside of the political system, it is still highly politically aware, and it wants to have a program, I'd argue, where it doesn't look like rates are being cuts are halted as a result of the election or who might be leading the election at that point. So I think from them, they want to have a clear message, as Brian said, aligned with the markets and a consistent narrative. So when cuts come, it doesn't look like it's designed to favor any one politician, party, or policy.
So, Brian, we just heard Alex bring up the election conversation. Obviously, it seems like there's still somewhat uncertainty when it comes to when we could get these cuts, how many we could expect. How are you advising your clients when it comes to positioning their portfolio amid this Fed uncertainty?
So this looks like it's going to be the second longest plateau for the Fed funds rate that we've ever seen. The longest one was 15 months between the last Fed rate hike and the first Fed rate cut. That actually came in 2006, 2007. I think dare say the Fed probably wishes it would have cut a little bit sooner at that point. So because this is so unusually long, what we're looking for really is any signs of a break in the economy. Is the economy sort of going to wilt under the pressure of higher interest rates? Now, we don't know exactly where the neutral rate is. That's one potentially source of surprise that we could see tomorrow in the dot plot. If a few FOMC members raise their estimate of where neutral is, that's effectively changing policy without actually changing rates. But I think the concern that we have is that we're going to start to see further weakness in the labor market data before we get down to 2% on inflation, which seems like it's sort of the bogey for a lot of these FOMC members. And that means the Fed's going to have to really choose between, do we have to wait for inflation to get all the way down to 2%, or do we try to forestall what looks like a coming weakness in the labor markets and in the broader economy?
And so does that mean, Brian, I'm just interested in your outlook for the economy then. Are you in a soft landing camp still or no?
No, we've never been a soft landing camp. We're in a hard landing camp.
Hard landing.
And this, we're becoming an endangered species. But the weakness that we're seeing in some of the survey data as relates to small businesses, poor sales, weak hiring, these are the things that tend to lead by about 3 to 6 months actual changes in the hard data. So we're waiting for that to hit around the time when the Fed is expected to start cutting rates. It may have to start cutting sooner or faster than it wants to.
All right, Alex, how about you? I have to get your opinion on are you in the hard landing camp, the no landing, soft landing?
You know what? I've been in the soft landing camp and still there, but I'd point out we've done a pretty good job of poorly defining what is hard, soft, or no. I think where I agree is that there could be a risk of cuts coming at a different rate than the Fed expects because, let's face it, for a long time, it's done something it's not used to doing. It's had a campaign against employment in an effort to bring it down. And we're starting to see that. We saw it happen late last year. We're seeing little bits and bots of it now. But I think the Fed is also thinking about something else. Commodity prices are starting to tick up, and that usually leads towards inflation in and of itself. So I would suspect right now most folks sitting at the governor's table are wondering, okay, we kind of know what to do from here if all goes to plan, but what are the things that might happen outside of the plan? And what if that is inflation from commodities prices that start to trickle up, and that also makes employment worse? How do we deal with the need to cut and rise all at the same time? And I suspect that's where we're going to start to hear more Fed speak in the back end of this quarter, and certainly a lot of that in Q2.
And Brian, back to you. So given kind of the backdrop, Brian, kind of your outlook for the Fed, for the economy, in the equity market, where do you want to be positioned, Brian? What sectors look attractive to you?
So this is the stage of the cycle where you typically see a risk-off rally. So it's possible the stock market can keep going up, but it's going to be led by more defensive areas of the market. Again, we can go back to the last two major cycles. It's exactly what happened in 2000, 2007. The tech rally and the financials rally relinquished to utilities, consumer staples, as we got the last gasp of the overall S&P 500 rally. And once that tapped out, it was around the time when the Fed was cutting interest rates because employment was getting worse. So we're looking for, again, ultra defensive sectors of the market that are correlated with interest rates. So when interest rates are falling, they're going to tend to outperform. We're looking for utilities, consumer staples, certain parts of the healthcare sector, your classic defensive counter-cyclical parts.
Mm-hmm. And Alex, if we are in this higher for longer period, what do you think of interest rate sensitive areas of the market like small caps? Do you believe they're undervalued and now is a time to buy in?
So I think small caps have been undervalued for a long time, and it's a good time to buy them. I don't know if the interest rate change is going to be the immediate trigger for them. I think that's going to be a flows-driven rally. It needs to get enough buyers back into the market to push them up. Because arguably, we can look at the Fab 4, right? It used to be Mag 7, but now really just 4 that are still making new highs. That's not because efficiency is improving or free cash flow is growing at great rates. It's rather just supply and demand. And we need to see a bigger impetus for that to move out of those biggest mega cap, large cap names and work its way down. Interest rates may be part of that, but I think it's going to be largely sentiment driven. Once you see volume going to those funds, those ETFs, those SMAs, you're going to see the rest of the volume follow pretty quickly.
And Brian, got your outlook for kind of the equity market for fixed income investors who are listening right now. Any advice, guidance you'd give them?
Spread compression has been extremely aggressive. We tend to think of this as a leading indicator, but it feels like that the credit market's already leading us past the downturn to the next recovery. We're pretty cautious. We like long duration, high quality. We've been talking about buying long treasuries since last year when rates were kind of at their top. Those were going to tend to be one of the only things that work in a portfolio of diversified asset classes when things get really tough.
And then Alex, we've been talking about this broadening of the market right now, especially when we talk about tech sort of pulling back. Where do you see that market broadening to? And do you think there are other opportunities out there besides just the Magnificent Seven?
Yeah, I think there are a lot of great opportunities. I agree with Brian. First of all, if you want to be out of the equity market, something like U10, UTWY, U30, get really targeted treasury exposure on the long end of the curve. Within the equity markets, I like energy as a sector. It's trading at about twice the buyback rate and twice the dividend rate of the broad S&P 500. You can do that through a name like Diamondback Energy, FANG, which is more of the high beta side. Upstream producer, has a lot of capability and efficiency. Or if you want a more low beta version of that, something like MPC and Marathon, where you're going to get a little more diversified, a little more muted exposure, a little more of a value play. And I think that sector also ties into if energy prices continue to go up, which looks to be set, or other commodity prices go up, they have two ways to benefit from that, as well as being a hedge against some of the tech names starting to fall.
All right. Brian, Alex, thank you guys both for joining us today. Appreciate it.